In our journey through macroeconomics, we delve into the significant influence of government on economic stability and growth. Governments worldwide play a vital role in managing economic affairs through fiscal and monetary policies. In this video, we explore the intricacies of these policies, their objectives, and their implications on the broader economy. Understanding how governments use fiscal measures, taxation and spending, and monetary tools, central bank interventions, will shed light on the complexities of the global economy. Our goal with this series is to provide viewers with a better understanding of macroeconomics, so they can make more informed decisions when navigating both traditional and cryptocurrency markets. Fiscal policy, the government's tool for economic stability. Expansionary fiscal policy. When an economy faces a slowdown or recession, governments may implement expansionary fiscal policies to stimulate growth. This approach involves increasing government spending on public projects and services, such as infrastructure development, education, and healthcare. Additionally, tax cuts are employed to provide households and businesses with more disposable income, encouraging consumption and investment. By injecting funds into the economy, the government aims to create a multiplier effect, where increased spending leads to more income and further economic activity. Contractionary fiscal policy. On the other hand, when an economy experiences high inflation or overheating, governments may opt for contractionary fiscal policies. These measures involve reducing government spending and increasing taxes to curb aggregate demand and control inflation. By withdrawing funds from the economy, the government aims to slow down spending and prevent excessive price increases. However, implementing contractionary measures requires careful consideration, as they can lead to reduced economic growth and potential job losses. Monetary policy. Central banks' influence on the economy. Controlling the money supply. Central banks have the authority to influence the money supply in an economy. By buying and selling government securities in the open market, they can increase or decrease the money available in the banking system. Increasing the money supply is known as expansionary monetary policy, while reducing it is called contractionary monetary policy. These actions impact interest rates and the availability of credit, which, in turn, influence spending and investment decisions. Interest rates and their impact. One of the primary tools of monetary policy is adjusting interest rates. Lowering interest rates encourages borrowing and spending, making credit more affordable for consumers and businesses. This stimulates economic activity and investment. Conversely, raising interest rates discourages borrowing and spending, which can help control inflation but may also slow down economic growth. Fiscal versus monetary policy. The key distinction lies in who wields these policies: governments for fiscal policy and central banks for monetary policy, and the tools they use to achieve economic objectives. Coordination of fiscal and monetary policies. Governments often coordinate fiscal and monetary policies to achieve specific economic objectives. In times of economic recession, expansionary fiscal policies may be accompanied by expansionary monetary policies to provide a more comprehensive boost to the economy. Likewise, when inflation is a concern, contractionary fiscal policies may be reinforced by contractionary monetary policies to counteract excessive demand and price pressures. Challenges and limitations. Both fiscal and monetary policies involve time lags in their implementation and impact. It takes time for changes in tax rates or government spending to affect the economy, and the impact of monetary policy changes on interest rates and credit availability may also take time to be fully realized. Political considerations. The effectiveness of fiscal policies can be influenced by political factors. The approval and implementation of certain policies may be subject to political debate and negotiation, potentially delaying their application during critical economic situations. Central bank independence. The independence of central banks is essential for effective monetary policy. Political interference in monetary decision-making can compromise a central bank's ability to maintain price stability and manage the economy effectively. Cryptocurrencies and macroeconomic policies. Within the blockchain industry, the decentralized nature of cryptocurrencies can challenge traditional monetary and fiscal approaches, urging governments to rethink strategies for economic stability. As such, It's crucial that governments, regulators, and the crypto industry work together to establish a regulatory framework that encourages innovation while safeguarding financial systems. In conclusion, fiscal and monetary policies are powerful tools employed by governments and central banks to shape economic outcomes. Expansionary fiscal policies stimulate growth during economic downturns, while contractionary measures help control inflation. Meanwhile, monetary policy adjustments influence interest rates and credit availability to steer economic activity. Understanding these policies and their interactions is essential for policymakers, businesses, and individuals alike, as they hold the key to achieving economic stability and sustainable growth in the global economy.